Hi there, my name is Blayne Rush and I'm with Ambulatory Alliances. We are here answering questions that we've received from previous webinars via email or from phone calls, but wanted to introduce myself and our firm before we get started. We're a full-service healthcare investment banking firm, an M&A brokerage firm that has significant experience in advising physician practice owners and owner-operators of outpatient centers. You know, I have close to 18 years of healthcare experience with considerable expertise in the areas of business transactions, revenue enhancement models, and complex negotiations and financial analysis and valuations. I've worked with over 250 healthcare organizations on transactions, hold a master's degree in health promotions, have an MBA, have an executive certificate in private capital markets from Pepperdine University. I'm also a certified financial analyst and have significant coursework towards a graduate degree in negotiations and mediations from SMU. I hold multiple FINRA licenses, Series 79, 63, 24, 82, and 99. I'm also a licensed real estate broker, and I'm an active and credentialed mediator and arbitrator. Do a lot of arbitrations. What we do is we're market makers, and we understand the transaction from a 360-degree view. We understand it from the various business structures that comply with regulatory bodies and the ones that are the most advantageous tax-wise. We know the valuations and their standards. We also understand the operations of your businesses. We know many of the players in the market, and most of them know us. We work extremely hard up front to ensure that you have no blind spots and that we leave nothing unnoticed. We take time to see the details that others have turned a blind eye to. You know, because we understand that it pays to be more prepared. You know, preparation is a huge key. We spoke about that many times. Because we know that the more prepared we are and the more systematic we are in our approach, the more respect that is garnered from the buyers. This helps the buyers see all the value of your business that we are marketing, and virtually ensures that our clients capture the maximum value of their transactions. You know, I'm a student of negotiations, valuations. I constantly study past transactions, mine and plenty of others that are out there. We study other deals. We understand and study the value drivers from each of the potential buyers' eyes and what makes those buyers buy and increase their purchase price and terms. We're in constant contact with those guys. We know your market and we get results. You know, if you would like to discuss your unique situation or have any questions, please feel free to reach out. You know, we'll answer them on the phone. If you do it by email, we might add them to this type of program. But nonetheless, we'll get your questions answered. If we don't know it, we'll get you to the right people. You know, but I want to commend you on investing your time into learning more about your business, your growth, and your potential transaction. You know, so let's get started with the presentation and what we're really here for in answering the questions. So I've received a few questions around private equity investing in healthcare. The questions have been, why are they interested, and what's the benefit to the seller and the patients, and what's the benefit to the healthcare industry as a whole? You know, private equity groups are considered financial sponsors. So when you hear financial sponsor, private equity groups, that's these guys. They in of themselves buy for the financial returns. You know, let's take a sidebar here for a second, speak briefly and generally about how private equity gets paid. You know, private equity gets paid, and this is just a broad brush. There's different versions of this, but generally speaking, they get paid on a 2 and 20 basis. They get 2% of the money under management for a management fee, and then they get 20% of the up, meaning the profit of the portfolio. Portfolio will consist of multiple companies that they've invested in. Could be, for example, 2 to 3 healthcare companies, could be a financial services company, could be manufacturing, could be IT, could be internet-related businesses, any of that type of stuff. So they either invest directly in a platform or through a platform. So what's a platform? A platform is a company that does what they're wanting to do. So, for example, in healthcare services, say it's a urgent care platform. So it's a company that has, just say, 10 or 15 clinics around the region, around the nation, whatever, that has a solid management group and has a model that can be replicated. That's a platform. So they either invest directly in a platform or through a platform. So through a platform would be, for example, hey, they already have that in the same example, the urgent care center platform, and they have their money working through that platform. So they want to do roll-ups or add-ons, or add-ons could be more urgent care centers, could be a ER, physician practice management company, that type of stuff. So they invest through or in a platform. They have size requirements, depending on the private equity group. We've seen that shrink a little bit over the last few years, but you'll get if you have 5 million and above EBITDA and a lot of the other things that they want to see in a business, a good replicable model, a successful model, they have a good management company in place, etc., you'll get their attention. I get that there's some ASCs, some radiation oncology, some practices that have $5 million in EBITDA, but they don't have some of that other, they don't have a true business executive leadership team. That might not be a target for private equity. So there's a lot of things that they look at. We've also seen people dip down below $1 million in EBITDA, especially if it's a emergent or a new market. So like when urgent care first came about, let's call it, not when it first came about, but whenever it was getting hot and those guys were looking into that market, 5, 10 years ago, there were some of those guys willing to dip below $1 million because some of those centers and people that grew a lot didn't have a lot of EBITDA, so they weren't very profitable because they were putting their money back in, or they were a platform with 10, but they had built for a platform to be 30, meaning they had excess leadership overhead. So let's discuss a little bit what's in it. What's in it for? Let's say what's in it for the market. Private equity has been very successful with bringing various healthcare actors to the table, get those guys to work together. For example, 3-way ASC ventures. One of the big things that hospital health system or those types of networks, the challenges that they've had is they've not been real successful. Somewhat successful, but not real successful in being efficient in bringing physicians to the table and really knowing how to work with those physicians, support those physicians, compared to private equity. They've been able to do that. And so those are the things that those guys, that private equity brings to the table that is good for the market. So some of the other things that are good for the market is economies of scale. So they're able to increase the profitability of some of these entities while lowering the costs to the market, to the payers. ASCs, urgent cares, they're able to bring the costs down to the payers, be it the consumers or be it the third-party payers, and still increase profitability. We'll talk a little more about some of their efficiencies and what they do in a few seconds. Some of the good stuff that you want to hear about, what's in it for the owner-operators? One huge is that it's possibly get 2 bites at the apple. What's 2 bites at the apple mean? That you can sell a significant chunk of your business to private equity. They'll come in and work with you to grow that business 2, 3, 4, 5 times the size that it was. And now, while you have a smaller piece of the pie is much larger. And then there's another exit, and you get another liquidity event. So that's 2 bites at the apple. Expansion capital. Say that you're someone that has 5, ophthalmology practices or ophthalmology clinics. You have an ASC and some other ancillaries, and you want to go to 15, you want to go to 20, whatever. You can go out there and go to private equity, and they will have expansion capital, and they will come in and same thing, invest alongside you. You'll be able to sometimes take chips off the table, put money in your pocket, sometimes not, depending on how old and tenured the business is, how much capital is kicking off, etc. Because they want to know that you have significant skin in the game, that you're going to be there helping grow the business. This isn't about you getting paid whenever we talk about expansion capital. And then they're going to turn around and say, okay, they might bring in and say, you have to have a full-time development person, full-time CFO, full-time CEO, depending on what you have there now, and depending on the size. And they're going to go out there and put this plan together with you and go out there and execute it on a very aggressive timeline. The other thing is, the vast majority of the times when private equity buys directly your business, fair market value standard does not come into play. Compared to when a hospital buys your business, then the vast majority of the times fair market value does come into play. And so what that means is there's no restrictions on what they can pay you. It needs to be, they're not going to go out there and overpay just to make you happy. But in emergent markets, we've seen private equity groups pay significantly more than what the business probably is worth to anyone else, because what they want is that platform. So they're buying into the market. We say, excuse me, that they're buying into the market. The other thing that you get is you get sophisticated partners. Private equity has some of the most sophisticated actors or players out there. These guys are very smart. They study. They put a lot of money into studying markets. I've been a consultant to some of the largest private equity groups on some of these markets. They'll pay you on a per-hour basis to sit there and work with them, to educate them on the market, things like that. And we've been involved with some of the largest private equity groups. We're not allowed to talk about it because they're looking at some certain markets that they're not in, etc. But they invest a lot of time, a lot of money, a lot of effort into market information, and they don't get it right, get it wrong very often. Whenever they're looking at some of these different markets, whenever they go in early stage markets, venture capital, that's a little more gambling, if you will, but they don't get it wrong very often. So they've been very successful in consolidating like healthcare service businesses, which increase the sophistication of those businesses. Because say that 15 centers can hire, they consolidate 15 centers. They can, when it's at that size, you can hire a high-level business leader or business leaders that are focused on growth, decreasing inefficiencies, negotiating better contracts, etc. When 1 or 2, 3 physician practice can't do that, and so they can't afford to do it. So whenever they bring all these guys together, they're able to do that, and they're able to grow the business significantly and to increase the profitability. They've been able to increase the profitability from 15 to 25% to start from 15 to 25%, and they could go to 25, 50%. That's huge when you're working with very large numbers. Private equity, once they grow the platform to a certain size, they can have all of the buyer types as an exit strategy because, because they're a certain size, and all of those different players in the marketplace have a strong interest in that. Plus, we talked about no fair market value when the private equity invests in the physician's practice or buys a physician practice or a healthcare service-based facility or facility-based healthcare services. So whenever private equity sells, fair market value typically doesn't come into play. So that's an interesting thing to think about because it's huge and people don't think about that a lot. So remember, many times fair market value does not come into play when a doc sells to a private equity, say compared to a hospital, nor does it typically come into play when the private equity is selling to a health system. That's why the private equity is sometimes offering the highest prices, So I think those, hopefully I've answered that question. Those questions give you a little bit of insight of private equity and how they work and what are the benefits to you as a potential seller, what's the benefits to the marketplace, out there. I again commend you for taking time to invest and learn. If you have questions, please get with us. You'll have my contact information in the text under this video, and we look forward to continuing this dialogue on other subject matters. Thank you.